current holdings or stocks that you're not in? What do you think is another candidate that we're ignoring right now that has this type of potential?
You know, I love it. I love it. We come on the set. It's like, what is the thing that will go up 40%
and immediately? If you
well, welcome to the market that we're in.
You know, I mean, the fact of the matter is, I'm not smart enough, nor are most retail investors at home, to pick it that closely, right? The reason we've been in Nvidia is because we know they are the market leader. We know that they are the cheapest in the trade. And so we just had to assess at some point in time, numbers would matter. The economic law of gravity here is that if they deliver the returns that we expect that they're going to deliver, then one of two things is going to happen. Either they'll buy back all their own shares because the market won't value them, or the market will buy them. And I think the market at this point in time is saying this doesn't make any sense. But if you said to me, Josh, Brad, what is the catalyst that finally got this thing moving? I couldn't tell you.
Yeah.
Here's my question, though. As we sit here and talk about Nvidia being at all-time highs, I personally own the stock, so I have a vested interest in it going up and to the right. But as I look at a company like Cerebras getting ready to IPO, what they do is proposing to come for Nvidia's lunch, right? Like, their approach to inference is completely different from what Nvidia does. It's completely different from the Vera Rubin cluster that fills the rack that we're supposed to get excited about this summer after we hear about what it's going to change and what demand for that looks like. So maybe that explains why the stock had such a hard time blowing past 180, and now we're seeing the excitement as the entire semis space has moved up. But realistically, after earnings, a little bit of air gets let out of that balloon because we have a chance to learn that even if it's not Cerebras, somebody like that is coming for those 80%
Sure,
margins.
but I would just say before Brad answers, I mean, Brad and Jensen Huang himself have been so bullish and optimistic about what inference is going to mean.
Sure.
2 years ago, you and Jensen were sitting on the podcast together talking about this very issue, how they both saw what this was going to mean. I want you to watch the clip and we can talk on the other side.
Inference is about ready because of chain of reasoning.
Yeah.
Right?
It's about to go up by 1 billion times.
Right, by a million X, by a billion X.
That's right. That's the part that most people haven't completely internalized. This is that industry we were talking about, Bud. Right. This is the Industrial Revolution.
Right. My take from that is that in an industrial revolution in industry, there's not going to be one winner, not one big winner. There are going to be many big winners, and this company is going to be right along there, right?
It's so extraordinary watching that. Josh, you and I were just talking. Sometimes
cut rates, there's no logic to doing so presently. You can't just quote the Dallas trim mean or the Cleveland trim mean. Remember, Arthur Burns reduced everything to two variables, and we know what he did. He set the pace for one of the greatest inflations of all time. So I think when I say he's providing cover for Kevin, Kevin's going to be under a lot of pressure from the committee not to move. There are some on the committee who actually would like to increase rates. I doubt they will move in these first couple of meetings. And you know who will get the blame for it from the President of the United States? It'll be because Powell is resisting. And I think it's pretty noble of him to take that heat. And I think he will be, the heat will be turned on him. Yeah. But I think he protects Warsh in that fashion. Warsh has to think about what his legacy is going to be 20 years from now. He's only 55. He's a young man. He'll be next to McChesney Martin or equal to Martin, the longest serving Fed chairman in history. So I think that is a good thing, not a bad thing. And I think it's a noble thing to do. And if I were him, I'd do the same, but I'm not sure I'd have the guts to do it just like he does.
Back in February, which stands for Heavy Assets Low Obsolescence, the idea was looking for names that would not be displaced by AI. Well, today, ETF provider Roundhill is launching a new fund to capture that strategy. Roundhill CEO Dave Mazza joins us now. It's good to see you. Welcome.
Thank you.
So how did this all come about? You heard Josh talk about these names and thought, hey, might be a good IPO. I mean, a good ETF. My head's in the IPO world. Sorry.
No, understood. And it's not that too far from the truth. I think Roundhill Investments is actually best known for our thematic AI technology-focused ETFs. But when we saw this term that Josh Brown coined, it really resonated with us due to the fact that, of course, we're seeing AI disruption across industry after industry. But these companies are really AI immune and have the ability to withstand whatever occurs with large language models or agentic AI because of their durability by focusing on hard assets and low obsolescence.
You get a founder's fee out of this or anything, or?
Oh, no, I'm involved. So I spoke to these guys shortly after they filed, and I said we could like do a deal together or like maybe a lawsuit. I don't know. What do you want to do? And no, I know. So I know Dave and his co-founder Will Hershey. They're terrific guys. I know them for a long time, and I've been impressed with a lot of the products they've launched. And I said, if you guys are going to do this, I want to help. I want to be involved on a limited basis. I have like 12 other day jobs. But I love what they've built. And because I'm in such agreement with Brad Gerstner about the disruption that's coming, and because names like Adobe, which is now 10 times forward earnings, and ServiceNow and Salesforce, they're all on the 52-week low list, and they go lower every week. I was looking for a way to say, I want to own the S&P or the Russell 1000. I want to own the market. But what's the least disruptible names that I can own? So just looking at their top 10, and this is not an endorsement of any individual stock. It owns TFI International. Brad, you know what that is?
Nope.
Good. Nobody does.
Hey guys, welcome back to my channel. I hope you all are doing well today. So without wasting time, let's start our video. NVIDIA's biggest problem isn't the competition, it's the keeping up with demand. For years, investors worried about one thing when it came to NVIDIA, that is competition. Would another chip company will catch up? Would hyperscalers replace NVIDIA with custom silicons? Would a new startup disrupt the market? Today, NVIDIA faces a completely different challenge. Keeping up with demand, and according to Jensen Huang, the industry's biggest bottleneck may not even chips anymore, it's power. Think about that for a moment. Not customer, not applications, no, not adoption. The problem is power. The AI industry has advanced so quickly that electricity infrastructure is struggling to keep the pace. Data centers require enormous amount of energy. Every new AI models require more compute. Every new AI agents require more inferences, and every new AI powered services require additional capacity. And all of it ultimately depend on power. That's why conversation throughout the technology industry has increasing shifted toward the infrastructure, power generation, grid expansion, data centers construction, cooling system, networking, memory. These all are becoming just as important as chips themselves. In many ways, the AI race is transforming into the infrastructure race, and that's incredibly bullish for companies positioned at the center of the ecosystem. NVIDIA remains one of those companies. The reason is simple. No matter which AI trend emerges next, the more compute is usually the answer. Agentic AI, more compute, AI assistant, physical AI, humanoid robots, automation system, all need more compute. Every road seems to be lead back to the infrastructure. That's why many investors believe the market is still underestimating the duration of this cycle. Years ago, many people expected that AI spending too slow. Instead, spending is accelerated. Today, many of the world's largest technology companies are increasing capital expenditure rather than reducing them. They aren't acting like a companies preparing for the slowdown. They are acting like a companies trying to secure a scarce resources before competitors do. That's a very different distinction, and it's one reason NVIDIA ecosystem continue expanding. The company is no longer just a GPU supplier, it's becoming an infrastructure partner, a software platform, networking provider, system architecture, and AI factory builder. The deeper AI penetrates the economy, the more valuable that ecosystem becomes. What fascinating is that many investors remain focused on quarterly stock momentum while ignoring the larger transformation taking place under the arm. Artificial intelligence is steadily becoming part of everyday life, not just inside the research labs, not just inside the cloud providers, everywhere. Consumer devices are becoming AI devices, enterprises software is becoming AI software, and manufacturing is becoming AI driven. Healthcare is becoming AI assisted, and eventually many physical products will contain intelligent agents. All of those trends create additional demand, and unlike previous technology cycle, demand is arriving before enough infrastructure exists.